Hey guys, Austin Schneider here, and today we're going to give you the top 5 mistakes that people are making when applying for a mortgage. And we're going to go through 5 mistakes, we're going to count them down, and we're going to give the biggest mistake at the end, so be sure to stay till the end to find out what the biggest mistake is. Mistake number 1 that a lot of people are making is not checking their credit before they apply for a mortgage. You know, credit is one of the biggest factors when it comes to getting a mortgage. And if you're waiting to check when you're applying for a mortgage, you know, you could be missing out on opportunities to grow, or you could discover that you don't have credit or you have little credit and that you may not even be qualified to start thinking about purchasing a home when it comes to credit. Even if you have good credit, you know, credit in the 700s, it still may make sense to, you know, take a step back, work on your credit, and improve your credit in order to get a better rate. 30-year mortgages are based off of credit tiers, so even just 1 point could make a difference. If it's from 719 to 720, that can drastically improve your rate. So that's why it's so important to be checking your credit before you start to apply for a mortgage to see if there's some improvements that you could make to get you a better rate. When it comes to timing of checking your credit, I mean, realistically, you should be on top of it for the most part. But if you are considering purchasing a house, the sooner the better. I mean, it can take up to a year to improve your credit scores. So if there's room for improvement, just know that it will take some time to start building that credit, so the sooner the better. There are plenty of resources online that will show you your credit history and your credit report. It'll show you, all the accounts that are open, if there's any late payments, or if there's any hiccups that need to be taken care of. In addition to the online resources, a lot of banks are offering free reports as well, so be sure to check in with who you're banking with to see if they offer some sort of credit report option for you. And just note with the credit that it does take time to repair any fixes, if there are any fixes, or even takes time to improve your credit score. So if you feel that you're ready, if you feel your credit is in a good position, then absolutely it might be a great time to apply for a mortgage. The second mistake that a lot of potential home buyers are making is paying rent late. Guys, this is a bigger deal than a lot of potential home buyers may think it is, simply because rent is the #1 indicator to lenders if you're going to be paying your mortgage on time. The lenders can check in with your landlord and see and ask them if you've been a good renter, if you've been making your payments on time, and they'll use this to indicate whether they think that you'll be a good borrower and be able to pay the mortgage on time. This is especially important, if you don't have a huge credit history or credit history at all, because the lenders are going to be heavy reliant on the resource of your landlord and the resource of you paying your rent on time. If you haven't been, or if you've missed a payment, then what we can just suggest is, start getting on it and start building up that rapport of on-time rent payments, because again, this is a huge factor when it comes to qualifying for a mortgage and applying for a mortgage. The third mistake that we're seeing a lot of potential home buyers make is buying an expensive item, even years before you're applying for a mortgage. So you may have heard that buying a high-ticket item when you're in the pre-approval process, or when you're in the process of buying a home, is a mistake. While that's very true, it can also be a mistake if you are thinking about applying for a mortgage years from now. This is because a simple $500 payment, say $500 car payment, can diminish your purchasing power by almost $100,000. For every payment that you're taking on, you're simply diminishing your purchasing power in the amount that you'll be able to borrow. Let's take a quick look at an example. Buyer number 1, Lisa, has an income of $75,000 per year. She drives around an older vehicle, but it is paid off. Additionally, she has only $100 per month in debt payments for a small student loan and a credit card she barely uses. She applies for a mortgage. The lender tells her that she can get up to a 36% debt to income ratio. With that ratio, Lisa finds out she can buy a home for about $390,000 thanks to her thrifty lifestyle and staying out of debt. Now, let's look at an example with another buyer with more debts. So buyer number 2, Mark, also makes $75,000 per year. Mark bought a car 2 years ago and pays $500 per month for this car. He doesn't have much debt besides that. He pays $100 per month in student loans and credit card payments, just like Lisa. totaling his debts to be around $600 per month. Mark applies for a mortgage and discovers he can also afford a 36% debt-to-income ratio, but the car payment he is using takes up a lot of the available income. His maximum payments let him buy a home for $300,000. As you can see, a simple $500 car payment can make a big difference with your purchasing power. It can mean that new construction house, or it can mean that older house that requires some fixing up. $100,000 is a big deal when purchasing a home, so it's important to just have your priorities straight and also make a mental note of this as you're starting to add more debts to your situation. Mistake number 4 that a lot of potential homebuyers are making are simply just applying with one lender. One thing a lot of potential homebuyers don't know is that you can apply with multiple lenders, and you'll be able to leverage the fact that you're applying with multiple lenders to save you money and get you a better rate. Lenders surprisingly have a lot of flexibility when it comes to offering better rates or giving some sort of discount, and especially if you're applying and leveraging other lenders to get you a better rate, that's only going to help you at the end of the day. The only way to leverage lenders to see if you can get a better rate is to get a few written quotes. This will do one of two things. The first thing, it'll see if the first deal that you're getting, the first quote that you're getting, is as good as you think it is. If quote number 1 is 4% interest rate at $3,000 in fees, and then you get a second quote that's 3.75% at $2,500 in fees, the first quote doesn't seem as good, and you could have been missing out on that discount that the second lender is offering you. The second thing that it's able to do is it gives you leverage to allow lenders to compete for them. If you take a written quote from XYZ company and you present it to a different company, then they'll likely be able to compete for your business and try to earn you as a borrower. It is a huge mistake to just take the first quote and run with that. And it is uncomfortable. It can be uncomfortable, especially if you're working with a family friend or a close friend that's helping you get your mortgage, but it is paramount if you are wanting to save money and get the best deal at the end of the day. Since you're likely going to be paying for this mortgage for 30 years or for a very long time, even a slight savings on your interest rate can be a big deal. So please, please, please take your quote out and let the lenders compete for your business and get some second opinions on your mortgage. And the biggest mistake that we see a lot of potential home buyers make is applying too late. And applying too late is really, once you start searching for a home, you should already be applied. So if you're searching for a home, then it's too late. Unless you've started talking to a lender, giving them your credit, showing them your income, filled out all the paperwork and had a pre-approval letter, you're likely too late. Without going through this process, you run the risk of finding your dream home and finding out that you're unable to buy it. Not only is this an emotional roller coaster for you as a home buyer, but it's a lot of wasted time, a lot of wasted hope, searching the internet, going to open houses, looking at homes and getting your hopes up. So let's look at an example of what being too late can do for you. So let's take example Mark. He's been searching houses online for the last few weeks. He's been spending his weekends going to open houses, and he finally finds a house that he likes. He talks to the realtor, wants to submit an offer, but realizes he can't because he doesn't have a pre-approval letter. The house is $400,000, and when he goes to start the pre-approval process with his lender, he's rushing, he's kind of hustling and bustling, trying to get an offer in on this house, but he discovers that he's only pre-approved for $300,000. And since this house is $400,000, he's not going to qualify, so he's going to have to start the process all over, go through the emotions of finding his dream home, and start his search again for a significantly lower priced home. Example number 2, which is the right way to do it, is Lisa. So Lisa's been searching online. She's been starting to think about purchasing a home, and she did some self-assessment and thinks that it's really time that she starts to enter the market and to purchase a home. Before she starts going to those open houses and spending a lot of time investing her time into finding a house, she knows that she needs to go through the pre-approval process, because if she finds something, she'll want to be ready to purchase it. So she goes online, gets a pre-approval. The next day, she's pre-approved for $390,000. She walks into the same house that Mark walked in, the $400,000 house, and realized that she could submit an offer at $390,000, and she does just that, and she got the house. You know, Lisa got this house because she was prepared and she knew what she was able to, you know, purchase. She knew what her purchasing power was. And at the end of the day, she saved a lot of time and a lot of energy searching these open houses and getting her hopes up on something that wasn't realistic. So guys, this is by far the most important thing. The number one mistake that we see a lot of people make is not getting pre-approved before they are searching for a home. You want to know what you can buy before you start searching. And again, it's gonna ruin your hopes. It's also going to waste a lot of time if you're not doing this. And it's a very simple process. It should only take you 24 to 48 hours before you're able to know how much you're able to afford, so you can start shopping within that small time frame. This little time investment of you can save you a lot of time at the end of the day. All right guys, we hope you've learned a lot on these 5 common mistakes that a lot of potential homebuyers are making when applying for a mortgage. For more about this topic, for more about purchasing a home, applying for a mortgage, visit us online at themortgagereports.com. Thanks so much for watching. We'll see you on the next one.